Good morning, everyone. Thank you for joining us today as we dive into COVID-19's impact on consumer behavior as it relates to the CPG space. We'll also hear about what innovation models are not working for large CPGs today and begin to introduce new investment tools corporate development can use to drive innovation in the next few years. It's my pleasure to have Nick Modi, Managing Director at RBC Capital Markets, with us. Nick covers beverage, household, personal care, and tobacco industries. Nick is a top-ranked analyst in the consumer space. Also joining us is Pano Anthos, founder and managing director of XRC Labs, a retail and consumer goods accelerator based here in New York. I'm Hallie Morsey. I run BD at XRC Labs, and I'll be moderating the session today. I have the pleasure of managing our corporate partnerships. Many of you are on the line. Thank you for joining us this morning. For those of you who are newer to who we are, XRC Labs is an innovation accelerator for the next generation of disruptors in the retail and consumer goods sectors. We run 2 programs each year that bring together entrepreneurs, investors, and corporate brands and retailers to foster rapid innovation in retail and CPG. We have 9 corporate partners. CVS Health, Estee Lauder, Accenture, and GS1 are of particular relevance in the CPG space and have given us access to the innovation happening at the enterprise level, as well as consumer demand signals. All of our corporate partners rely on us to be predictive, truthful, and connected. Predictive means access to early stage startups. Truthful means thought leadership, and connected means access to not only startups, but peer corporates, trade, and Wall Street. As investors, we fund early stage companies across the retail and consumer goods space. Sorry, I'll just minimize this so I can advance for you guys. We invest across the retail and consumer goods space. So we invest in consumer brands, supply chain, the consumerization of healthcare, next-gen commerce, on-demand manufacturing, and e-com tech. So a real breadth of investments. We've funded 80 companies over the last 4 years. And just to give you guys a taste of our consumer goods portfolio, we've invested in men's corrective cosmetics, skincare for the gaming generation, prebiotic waters, OrthoFX is our orthodontics play. We've invested in superfood dog kibble. The list goes on. Before I pass the mic to Pano, I'd like to encourage everyone to submit questions through the Zoom Q&A function, and we'll have a quick 10-minute Q&A at the end. And without further delay, I'll pass the mic to Pano.
Thanks, Hallie. In a story you may know well, before the Great Depression began, there were 2 cereal companies going head-to-head, Kellogg and Post. And when the Depression hit, Post logically reined in expenses and cut back in advertising, while Kellogg doubled its ad budget and moved aggressively into a new medium, radio advertising, and heavily pushed its new cereal, Rice Krispies. Profits at Kellogg's rose 30% and became the dominant player in the cereal category ever since. Today, we feel like we're in an unprecedented but equally disruptive time. In an unrelated news flash that I think you'll find entertaining, sources report that Major League Baseball is seriously considering implementing an electronic strike zone and holding all of their games this summer in Arizona. The purists of baseball have resisted demands for the technology, which was developed nearly 20 years ago, even though it would remove subjectivity from the game and improve play. Until Monday, they had made it clear that maintaining a tradition that had not changed in 100 years was more important than fairness and objectivity. COVID and the need for social distance between the umpire and the catcher and the batter change everything. If Major League Baseball wants to have a baseball season this year, they have to adapt. Nick and I are here today to discuss how Corona will shake up not just baseball, but any time-honored tradition. We know that old traditions die hard. We promise you Corona will speed up this change. And we will share with you that the current model for investment in innovation for consumer brands is basically broken from 2 different perspectives, from a leading Wall Street analyst and from startup land. A venture capital approach to building and investing in consumer goods startups may work for technology companies, but fails a number of tests with startup brands. We are convinced it's time to revisit how we build startups and engage with strategic partners and acquirers. You will hear us say often, necessity is the mother of innovation, not just invention, even for innovation processes themselves. And with that, I pass the mic to Nick.
Thanks, Pano, and good morning, everyone. In late February, I was in Boca Raton, Florida, attending the CAGNY conference. For those of you not familiar with CAGNY, it is the year's largest gathering of C-suites from the largest consumer goods companies and institutional investors investing in public equities. While COVID-19 was a key area of dialogue, it was primarily focused on the impact of supply chains and consumption in China. My, how things have changed. The evolution of this pandemic has created challenges for everyone: consumers, the healthcare system, governments, and yes, even sell-side analysts. What I wanted to do over the next 10 minutes or so is share my perspective on what I've been thinking about as it relates to the current situation. I'll first level set the discussion with some near-term thoughts, which at this point should be fairly obvious, and then share some headlines on what COVID-19 really means for the future. So with that, let's get on with the show. And there we go, whoops. So it's pretty clear by now that consumers have altered their consumption behavior. Data from Numerator, the largest household panel in the US, suggests close to 90% of consumers have changed their shopping behavior during the last week of March, up from just 33% before the panic really set in. And it's pretty clear how consumers are behaving, right? What we did basically is looked in scanner data. This is IRI data, and we took the top 10 categories and the bottom 10 categories in terms of kind of the last week's growth. And it's pretty clear, right? Consumers are stocking up on everyday items, and they're also consuming a lot more at home. On the other side of the coin, you know, people just don't feel the need to really look that nice these days because more and more of us are spending time at home. And that's why the beauty category has been under so much pressure. But even you have things like sun care, sun prep, right? Because people are going out less. So it's pretty clear how consumers are behaving. What I find interesting, you know, if you look at how or what consumers are searching online, the search for recipes on Google and easy recipes has spiked. In fact, we're seeing more searches for recipes and easy recipes right now than we do during the Thanksgiving period, which is typically a cook at home holiday. So it's pretty clear people are consuming more, they're eating more at home, and there's a lot of transfer of demand from on-premise venues into the home. Now, again, this is Numerator data again, and what I wanted to do is just kind of break down some of their perspective on what's driving the changes in retail, both in-store and online, which I thought was pretty fascinating. So you can see in-store, you know, number of households shopping really aren't changing too much, right? You have a 101 index versus the prior year. However, the number of trips has gone up 15%, and the weekly buy rate has gone up 23%, which gets you to retail sales up about 24% for in-store channels. And then online is another story. You have an 8% increase in terms of number of consumers buying online, a 37% increase in the number of trips or frequency, and a 13% increase in the buy rate for an increase of 21%. So it's an interesting way to think about kind of how the consumer is behaving both in the store and online. And we're seeing massive trial, right? Consumers are trying new products. 1 in 3 consumers are switching online, 1 in 4 are trying new products, and 1 in 5 are trying new retailers. Now, there's a whole abundance of factors driving this, you know, product shortages, stocking up on products otherwise they wouldn't need just because they're in the store and they may not know if they're coming back or not. Buying brands that perhaps they had abandoned several years ago, and we'll get to that point in a couple of slides here. Now, what's fascinating here, and something that could be much longer term in its orientation, is really how consumers are shopping. So you can think about click and collect and then online shopping, and you can see how, you know, you have first-time users, you know, 14% of those that are buying online or using click and collect are first-time users. You have 19% of consumers that are using it for the first time in 6 months. You have only 23% of users that are saying it's part of their normal routine, and 44% occasional users on click and collect, which, quite frankly, I think that number is going to go down over time as people get more and more comfortable. If they say it takes 3 weeks to build a habit, well, guess what? You know, this pandemic and us shelter in place is going to last longer than 3 weeks. And then you can see on online a similar type of dynamic. Now, what's interesting is RBC recently did a big broad-based consumer survey, and it's incredible how quickly things are changing. When you look at March 2020, and we asked close to 2,000 consumers, have you purchased groceries online? 55% of consumers indicated yes in the most recent survey. That number was 15% in 2015. So massive jump. It was 36% just a year ago. So massive jump in online usage. So I guess the question then becomes, what now? Okay, it's pretty obvious. People are pantry loading. People are consuming more at home. We know all these things. And so what I wanted to do is share 5 headlines with you, or 4 headlines, sorry, and what I've been thinking about in terms of some of the longer term implications to kind of frame COVID-19. Headline number 1, is COVID-19 a disruptor, or is it really an accelerant? Headline number 2, I do believe the big are getting bigger right now, and we have evidence of that and that we can quantify. Headline number 3 is kind of a thought I had about how corporate executive teams should perhaps add different roles to deal with situations like this, what I call the chief shock officer. And then headline number 4 is this kind of philosophy around entrepreneurship, built to last versus built to sell, and we'll get into each of these over the next 5 to 10 minutes. So let's talk about disruptor versus accelerator. This was a article written by the Wall Street Journal when they showed kind of Google searches for certain items, jigsaw puzzles, home workouts, kettlebells. It's clear people are staying at home, okay? Now the question is this a new phenomenon? And the answer is no. Now this is 2018 data. Prior, and this is from the NPD group, prior to COVID-19 even becoming a thought, people were already buying more games and puzzles. People were already buying more video games. They were already buying more barware tools and sets for home. They were already buying more sweats and sleepwear units, right? This was already something that was happening. Now, why is this happening, right? Since 9/11, and you can actually go back to 9/11, consumers have been cocooning more and more at home, right? This could be partly because of safety right after the shock of 9/11, psychologically. This could also be the fact that around that time, we started getting a lot more global news, right? Because of the evolution of the internet and the ability to procure information from everywhere in real time. And certainly this has opened up the landscape to all the other bad things that are going around the world. So people have been cocooning more and more since 9/11. Now, on top of that, obviously we have digital engagement, which is keeping people at home more. The less need to go out, I don't need to go visit my parents that are 10 minutes away. We could just FaceTime them in the evening, right? So things like that and digital engagement has obviously been a big thing there. The Netflix and chill, Hulu. I mean, just think about all the opportunities that we have to entertain ourselves at home, whereas we would leave the house. E-commerce. I remember I started my career in the late 90s, covering this company called Amazon. You might have heard of them. They sold just books online at that time. And I remember, everyone making such a big deal about e-commerce back then, but it kind of fizzled, right, with the tech bubble bust. But here we are, and e-commerce is now growing dramatically. And as we discussed, COVID-19 isn't disrupting this environment. It's not a disruptor. It's actually accelerating what was already happening. And obviously, e-commerce is going to continue to become a bigger part of our lives. And it's going to get more profound. Think about this. This is Amazon's one-day, same-day delivery in 2014, right? Their coverage. How they, you can order a product on Prime and get a product either that day or the next day. This was their coverage in 2015 for same-day, next day. Then they went on a building spree, fulfillment centers and warehouses. This was 2016, 2017, 2018. Today, Amazon can cover 72% of the population with same day, next day. Now, obviously, there's a bunch of the population that doesn't have that luxury, but hey, guess what? There's this company called Walmart that is also trying to provide similar types of services to Amazon that has a very big scale and share in the middle of the country. So I would argue that over the next 1 to 2 years, most of the US population is going to have access to same day, next day delivery. And then you have innovations like this floating warehouse that Amazon filed a patent for several years ago. This is some concept art that was created. Literally would be floating outside large events or in rural areas, and you would have drones deliver the product right to the consumer. Or you have Mobi, which is a 24-hour convenience store, which is being tested right now. It's almost like an Uber, and it can come around to your block where you can buy sundries or single-serve beverages. So there are innovations out there, and I can go on and on about companies innovating around fresh vegetables and just general groceries in terms of automatic delivery from the store to your house. So it's just going to be easier and easier to stay home. So again, I would say staying at home, this at-home channel is going to be a big theme, I think, for the next 5 to 10 years. Now, the bigger getting bigger. What we did is we looked at using Numerator, all these kind of center of aisle categories. And you can see that there's a lot of new consumption coming to these categories. Look at cleaning wipes. 24% of the spike in consumption has been due to new consumers. 29% for hard seltzers, but that's a new and emerging category. Even if you go to canned soup, 5% of the consumption has been people that never had purchased a canned soup, at least as the data was measured going back 12 months. And what we find fascinating is that when you look at the biggest brands, they are actually over-indexing to the new consumers. So consumers are new coming into the category, but they're disproportionately skewing their purchase consumption and habits towards some of the biggest brands in the categories. And these are brands that many believe were dead just 2 years ago. And what I also find interesting, and this is a frozen pizza example, is if you look at repeat buyers, so as trial has obviously gone up across the board, we're looking at repeat consumption. Where are consumers coming to repeat? Obviously, private label is going to benefit from trial because you're just trying to buy whatever's in the store. Some of the smaller brands are going to benefit, and some of the larger brands are going to benefit. But what we want to know is who's coming back to those brands. And you can see here clearly DiGiorno, which is one of the largest brands in the frozen pizza category, has actually had much better repeat, whereas you look at private label and you're seeing not as good of a repeat rate. So again, quality, the consumer is kind of coming back to quality as they make their purchases. Hiring chief shop officer. I won't spend too much time on this, but we did a 2025 study at RBC about 18 months ago. And one of the things we talked about was this escalating uncertainties, the fact that we're having black swans hit us time and time again. And you can think about, whether it be currency volatility, whether it be climate change, hydropolitics, nationalism, population imbalances and migration, supply chain issues, right? Product integrity online, fake news, right? And now add health epidemics to the situation, right? So you're having these issues pop up. But the reality is we're still not prepared for a lot of these things. Corporations were still scrambling. Governments were scrambling. And I think it's very important that companies rethink the types of roles they have on their executive team at the highest level with board level representation. Someone should be at a CPG company managing these types of black swans or preparing the company for these types of black swans. I'm not talking about a supply chain officer. I think it's someone that needs to be able to think about everything holistically, 360, online integrity, right? Data breaches, health epidemics, raw material shortages. And just think, this is not the first massive pandemic we've had, right? You can go back to 1331 or 1918 where we had the Spanish flu, right? We've been here before, yet we are not prepared. Think about it. This was a picture I pulled from 1918, an old picture of people getting back to life after the Spanish flu, wearing face masks, dressed up very nicely. Something that I think will look very familiar when we're all back at it when we get the all clear, hopefully sooner rather than later. And this was a press clipping from 1918. Public places are ordered to close. Again, folks, Mark Twain once said, history does not repeat, but it does rhyme. So here we go. We've already been here, yet we're not prepared. Last point is this built to last versus built to sell. If you think about the amount of money that has been available for startups and new ventures and innovative ideas, it's gone almost algorithmic over the years. When you talk about venture funds and accelerators and Saudi money, and there's so many, Kickstarter, there's so many venues in which you can raise money. And on top of that, in coincidence with that, we've had a dramatic drop off in interest rates. I remember talking to my father when he first financed our home when I was growing up and had an 18% interest rate. Wow, I'm borrowing money at 2.5% right now. So it's incredible to think about, the evolution of kind of entrepreneurship that has been built on this low rate environment. Well, balance sheets don't matter until they matter, right? And this whole notion of kind of growing at the expense of profitability, and growing to kind of get that multiple so you can get taken out. I think a shock like this kind of teaches us all that maybe that's not the best way to go about it. You know, being measured and slow sometimes is good when you're a startup enterprise. I like to use the energy drink category as a real great case study for a situation like this, right? Here's a category that has been growing phenomenally well over time. Low barriers to entry, so a lot of competitors enter the market, very high margins, and very good growth. Yet, if you go back to 2001 and fast forward to today, Monster and Red Bull have continued to consolidate the share in the category. It's because they did it slow. They did it market by market, right? If you think about Monster, it took them 11, 12 years to get into Walmart, not because Walmart didn't want them, because they wanted to build their brand market by market, state by state, sponsorship by sponsorship, making sure they were connecting with the consumer, making sure they were building the capabilities to scale up when Walmart did take them at some time, making sure that they were connecting with the consumer deeply, right? And that's why Monster and Red Bull had managed to build the kind of franchises that they've built. And you can see here, even in the 08-09 crisis, with one of their biggest consumer groups, which it's the construction market, construction workers, right, that take energy drinks to the site, they still had great growth when most companies that I follow had negative growth. And you can also look in the luxury industry for great examples of some of these brands that have been around for 100 years and are still growing very, very nicely at very high margins and very high price points. So with that, Pano, I'll kick it back over to you and we can have our discussion about innovation.
Thanks, Nick. I'd like to immediately segue into Q&A with both of you around the future of retail and consumer behavior. Let's talk about the future of stores and online commerce. How will stores come back after being shut for a couple months now? What could it look like? Pano, I'll start with you.
I think the outcome is going to be much smaller footprints, much more vertically focused, and that the vertical nature of the store will be that the brand will deliver the store much more so in a kind of onward motif if you're in the apparel or luxury sectors. I think consumer goods, the ability to have still the supermarket or the grocery is still going to be prevalent for some time into the future.
Yeah, and if I could just add, I mean, I always like to look at history, and benchmarks. I mean, think about what happened with the shock of 9/11 with air passenger traffic. It took 3 years post 9/11 to get to the passenger traffic levels of pre 9/11. Now, yes, we were going through a recession at that time as well, and the tech bubble busted. But I would argue, some of the economic metrics we're going to be looking at in COVID-19 are going to be just as bad, if not worse. So it's going to take time for traffic to build, and companies have to completely innovate. I mean, just think about movie theaters, right? Think about how Kroger is now talking about having only one direction lanes, so to take away traffic. So, challenges like this are tough to deal with, but they also provide amazing opportunities to innovate.
Yeah,
which I'm sure we'll talk about.
Yeah, because DTC is going to just continue to grow. I mean, this e-commerce platform that's sprouting at all the groceries now and really accelerating is changing consumer behavior. I think we've been very bullish on, as you have, Nick, on the e-commerce platforms, but they've been really slow to adopt. And I think consumers now realize, I don't need to go into the store to go to the center of the store. I can just order it online. So I think you're going to see a bigger shift there. We think that try-on areas where consumer needs to taste it, discover it, experience it are still going to demand a physical presence. But, if you know what you want, you can order it online today.
At the store level, what solutions are you guys seeing around social distancing? And do you think that will stick around for a long time at the store level?
Well, I'll take that one first. We have a fire code. That fire code was created years and years and years ago because we had fires and we had very dangerous situations resulting from overcrowding and under, kind of resourcing from a sprinkler and other vantage points. I think we're going to have a COVID code coming forward. We're going to have managing appropriate social distances that don't also always have to be turned on 24/7, but can be flipped on at a moment's notice to immediately recalibrate how many people come into the store. I mean, what's being done right now is a best effort, but it's all very manual. I mean, they're physically just counting the number of people that can come into the store without really knowing what the right six feet of distance looks like. There are technologies coming out right now that leverage the security cameras to actually help you manage that in real time, as well as across an overall floor plan. I mean, even the floor plan makes a difference. It can actually prohibit or inhibit or accelerate potential viral spread as people move around in your store. So it's going to become a bigger topic of discussion, much like the fire code had to be instituted.
Yeah, and if I could just add on to that, I mean, you think about, you know, these guards that are now going up at the register between the cashier and the consumer, right? You think about all that impulse space around the cash register, and how those categories could be impacted if there are less people going into the store. Even if people decide not to go online and go into the store, but they're limiting the number of people per day, that's going to create a lot of problems and a lot of headaches for a lot of impulse-driven items. So that's one thing to think about. And then we talked about this one way at Kroger. I mean, that's going to have a lot of dramatic implications. And just general venues where people kind of loiter, right? Like you think about a Starbucks and how people spend so much time during the day in a Starbucks and they consume more because they're there. So these are the types of things we have to think about. How do companies replicate those impulse points in a non-brick and mortar environment? I mean, I think that is kind of a key core capability that companies need to evolve to.
Thank you both. I'd love to ask a question of the day around department stores. Obviously, some of them went into this struggling. Curious what your points of view are on who will be the winners and who will be the losers.
I don't think there's a lot of hope for the traditional multi-brand retailer unless there's product scarcity that the consumer can only get through that retailer and that physical presence. Mm-hmm. The convenience of a department store, which was established over 100 years ago so that you didn't have to go from shop to shop, has been mitigated by e-commerce. You just don't need that kind of same threshold. Different in grocery because obviously your food shopping involves fresh and other aspects that are not easily just shipped online. And I'm sure even that will get innovation going downstream. But the department store of old where, you would just loiter and walk around and just shop leisurely. I mean, we don't have the time. And then the second component of this is we really are a little nervous about the social distancing question, and we will be for some time. So I don't think we're very, unfortunately, negative on the department store model going forward.
Mm. Yeah, and Hallie, if I could just add in there, I mean, on, my pre-COVID thoughts on department stores was a little bit more different, right? In the sense that in the existing structure, I agree with Pano. I think, there's not a lot of hope because the value proposition doesn't exist anymore. One thing that we talked about, just generally speaking of retail, is that, experiences are so important and technology can help facilitate and enable unique experiences for the consumer. I mean, you think about some of the teen retailers in New York City where there's like lines around the door, right? I mean, it's an experience for these people, right? And so you think about an Ulta or Sephora and why they did so well, because it was an experience, right? So I do think that there is hope. I just think COVID-19 throws a wrench into it right now because, again, social distancing is going to become a real big criteria, I think, in the consumer's mind in terms of where they shop and how they shop.
Thank you. I'd like to take a question from the audience. It's a great question. Do you think this event will accelerate the move to marketplaces, so Amazon, Alibaba, as it becomes too expensive, hard for startups to build their own e-com platforms?
I'll take it first.
You want to start that one, Pano?
Yeah, I'll start that. I would, on the face of it, it sounds like an absolute yes, but then how do you stand out on the marketplace? Amazon is not making it easy for startup. It makes it easy to get started, but they really want some advertising dollars spent their way in order to get your brand promoted. So I don't feel like there's a big shift here. I think the brand still has to build their brand. The most successful brands build their brand and then it gets sold. I don't think you go the other direction by selling, you build your brand. So I'm less concerned about the platform and much more concerned about things like, are you getting reviews of your product? Are you getting a community built around it? You know, look at some of the best brands that have been built in the last 10 years, and they've got massive communities following them and promoting them in effect, you know. So I don't think the marketplace is a mechanic per se that will change the way brands are successful, but it is a new channel of sales. There's no question that it'll continue to grow in that respect.
Yeah, if I could just layer on some thoughts there. I mean, and I agree with you. I think you should have your own identity and franchise if you really want to create a long duration brand, right? I think that's very important because the model these days now is connect with the consumer digitally, and then they can find you in brick and mortar, right? And there's plenty of examples to talk to that. The other thing I would say, and this is just kind of a big picture thought on, how, the number of touches a box will get between, getting produced and getting shipped to your house, I think is going to become a very important consideration now. Consumers are going to want to know. They're going to want to have transparency on how many people are actually touching this thing, given this COVID-19. I think that's going to be something that people will start talking about more and more. And that could become a marketing proposition for some more local players, right? Where it's like, hey, it's from us to you, right? From the farm right to you. One person touches it and that's it. And so I think, when you think about Amazon versus some of these other concepts, that could be a differentiating factor for many of these companies in terms of how they're getting the product to the consumer.
Well, there's a certain anecdote here I'll share with you, Nick, which is my family, obviously we get a lot of shipments. We have for many, many years. I've been a Prime customer since like 2006. We now let boxes sit outside our door for 2 days before we bring them inside, regardless of whether it's raining or not. I mean, just the fear and panic that the box is carrying something is mind-blowing to me. That we're now, even that Amazon shipped it in 2 days, we're seeming to be convenient and okay with 4 days, effectively 2 days of a kind of detox almost. So I think there's going to be a lot of movement in this area around, to your point, around certification of cleanliness, of purity, if you will, of not contaminated or potential contamination. And I don't think we're anywhere near a solution to that story yet. And so therefore people are going to take reactive measures in some cases, and hopefully not everyone does this, but it certainly will make the supply chain a little bit more stretched in terms of having to provide protective cartons and such.
Thank you both. I'm going to move us to the future of innovation part of this conversation. So Nick, the case study on Monster you walked us through in your slides is super interesting. It's a nice segue into how companies should innovate today. So we heard you talk about building companies to last, not to sell, building with strong balance sheets. You talked about building one-on-one customer relationships and being very strategic about distribution. We feel like companies that win at all of these capabilities will be the next class of consumer brand acquisition targets for large CPG corporates. So let's hear from you and Pano around how corporates are approaching innovation now, the challenges they're seeing, and what are some new tools that they can access.
Yeah, Nick, what I'm going to do is ask you a set of questions as you're the Wall Street guru on this. But corporates right now have 3 or 4 tools in their tool bag, so to speak, to innovate, right? First is internal corporate innovation, where they build the R&D internally, as they have for many, many years, and then roll out new products. How would you grade the success in the CPG industry of the internal corporate innovation efforts these days?
Yeah, I mean, for those that have been following my work, I have not been a big fan over the years of companies' abilities to innovate in this space. Now, I will admit things have gotten better, right? 2 years ago, I would have graded the average CPG sector as a 4 or 5. Okay, 5 is actually being too generous. Today, I think it's closer to a 6. Okay, my idea of innovation is not line extending a new flavor to keep your shelf space. That's not my idea of innovation. There is so much opportunity. I mean, if you just think about where the world is headed and all the opportunities and convergence and the fact that consumers are not making choices based on some predefined category anymore, and that things are converging, right? I just think there's so much opportunity to extend some of these amazing brands and new brands into a lot of different areas, right? And leveraging technology also. I mean, the convergence of technology and service and product is also happening. And Pano, you know better than me, with some of the companies you have in your portfolio, that is something that is happening, and that is something that can really have a lot of success. So that's kind of my big picture view on this.
Yeah, and I'm now going to ask you to do agree, disagree, or true, false, however you want to do it. I'm going to make a statement. You can tell me whether you think this is right or wrong. Venture capital-backed companies have driven prices super high, such that they're limited. The acquisitions of these companies are limited number and often very expensive. True or false?
True. True.
Okay. Next question. And we're going to then come back to this. So the second avenue that people have, corporates have done is kind of circle the Silicon Valley, New York City ecosystem, looking for startups to buy and acquire. But I think what we're seeing is they're very expensive and the return is very challenging. So another way that corporates are going after this is to get early access to startups. But our sense is that these have produced very limited results. Let me give you a couple scenarios and you can tell me whether this is true or not. So corporate investment in venture funds hasn't really achieved corporate innovation goals. True or false?
True. And let me just put in a little caveat. It depends on the company, right? Because I think one of the themes that are going to cut across a lot of these questions is how it's actually aligned and organized internally, right? How the system actually works.
Well, our contention though on that point is that a venture partner inside a corporation is not going to want to be compensated like everyone else in corporate America. They are looking at carry and interest and all kinds of other kind of flavors of compensation first. And second, venture funds don't typically segment appropriately to ensure that everything that they're investing in is going to be of interest to the corporation, right? So it's a very kind of hit or miss. If you do a general VC fund, even the best ones are very hit or miss. So we would agree that essentially just investing in a venture fund doesn't really move the needle. It's not a bad thing. It just doesn't move the needle on any front. Another area we've seen a lot of attempt is at corporate venture, where they set up their own venture fund. So have they worked or not?
No, not really. Again, it comes down to alignment. But what I find, and I've written about this recently, is when companies have these kind of in-house venture funds or groups, they're operated so separately from the company's own R&D function that I feel like sometimes the R&D function becomes weaker because they feel like the venture part of the organization has it, right? That they'll come up with the ideas and then we'll just kind of be able to improve them or what have you. So yeah, I've not really seen this work that well. Now, let's be fair. A lot of these venture groups internally at many large CPG companies are fairly new. So let's give them some time to kind of, work out the kinks. But no, I have not really seen it be that effective just yet.
Well, and I would also second that the ones that have tried it in the past, like a Best Buy, have abandoned their corporate venture. And we find two main reasons for that. One, the venture team and the corporation don't have alignment of interest. The venture team wants to make money, right? That's why they're doing this. They can say, yes, I want to feed the corporate R&D function, but often they'll invest in things that are just tangential. And the business is like, why are you investing this? We have no need for this. And the second is that it comes back to, again, that when a corporate VC builds, they're putting venture returns to work, and that requires strategic prices that are pretty high. If you're going to get a return, you got to get something much higher than a typical investment vehicle would be around a loan, for example. Okay, so the next one I want to ask you about is direct investments. So corporates have also said, okay, I'm not going to do a corporate venture firm. I'm not going to do investing in venture funds per se. I'm going to directly invest in startups, myself. Has that worked or hasn't it worked from your vantage point?
It depends on the model in which that investment is done. If it's done in a, hey, I'm just going to invest in this company and see where it goes, that has not been that effective. But when it's been done in a much more collaborative way, that has been much more effective.
Right. So maybe you can expand a little bit on what you mean by collaborative.
Well, when you make the investment and then you become kind of part of the business model, right? So let's take, I'll just give an example of Coke taking, instead of buying Monster, they took a 18% stake in Monster and became its global distributor and helped them really build their brand in many markets around the world, and doing it the Monster way, not the Coca-Cola way, which is because of their distribution, just kind of blow out, and be in every point of distribution in 20 days. Monster's been building its business in every country. And so that's what I call a classic example, right?
Well,
where you have a situation where, you buy a brand and you actually apply some of your marketing core capabilities to that brand, helping it, and then having some kind of, pre-negotiated kind of exit price or something after certain thresholds are met. Those are the types of structures that seem to be working better.
Right. Now let's kind of pick at that a little bit, because essentially a corporation doesn't want to pay big top dollar, right? So they want to be able to get in early enough and acquire an interest or the company at a reasonable price. Now that requires a level of risk that we haven't seen a lot of corporations be willing to take on a traditional venture model. They want to get on the cap table. They'd like to be in the board meetings, but the startup looks at that and says, wait a minute, if I take money from ABC company, DEF company is not going to want to talk to me. And I've just lost the ability to kind of get the best price. So, if you're early stage, and venture firms don't want strategics in these deals either, because for the same reason that essentially it's an option to purchase. It's almost like a right of first refusal that is being given to the corporate investor. And so the ability to kind of stay neutral is really hard for the startup, and to actually get an arbitrage, kind of bidding war going, if you will, if a corporate's on the cap table. Now, when Coke invested in Monster, it was a much later stage company, wasn't it? Proven out. Exactly. Right. So Coke could then measure their kind of investment and return and distribution impact. But those are pretty unusual circumstances, because the startup in many cases needs working capital. The startup needs marketing, as you said, marketing expertise. The startup needs a bunch of things that a Monster already had. So I think the thing that we're posing back to strategics now is, do they need to rethink this kind of investment model and get to a more collaborative state with the companies earlier, rather than waiting for a Monster to appear? And our sense is that if they want to get to a price ultimately to acquire the company, they're going to have to find a way, and there are ways to do this, and we can certainly talk about them, to get in earlier, reduce the risk, create upside for the startup so there's incentives to participate and engage fully, but also to essentially cap the acquisition price, which is an absolute no-no in the venture world. No one wants to hear about a capped, kind of exit, right? They want the sky to be the limit. So it's why we come back to, we think venture works really well in technology, but doesn't really work well with brands, because the unit economics are different, the cash requirements are different, the length of time it takes to build a brand is different. And so there's this, the kind of mechanics need to change. So we're hoping, and we believe that we can actually, we've seen this now with a couple of our portfolio companies, that we can actually come up with a more of a collaborative model in this industry, is what we're thinking. And we believe that from what you're telling us, it's critical. So Hallie, I'm going to turn it back over to you to kind of let you run with questions. So I'm not sure that we had, should we bring some questions forward?
Oh, sorry. There's a great question here that I received. What do you think this all means for supply chain for Amazon? For normal items on their subscribe and save, like TP, paper towels, and cleaners, do you think this disruption will be long-term or stabilize? They're still out of stock on a lot of panic bought items.
Nick,
You
why
want to
don't
take the
go
first crack, Pano?
Yeah, you take
Okay,
it.
I'll yeah, no worries. Yeah, no, I think, look, just like any retailer, right? Not having product on the shelf it's, rule number one, not to violate, right? So I think the combination, it's just so many polarizing factors, which makes the situation so fascinating, yet so complicated and so frustrating, right? Okay, on the one hand, I want more stuff coming to me because I don't want to go to the store. On the other hand, I went to the site and I can't get it anymore. And I'll tell you, just from a personal standpoint, there's things that we've been ordering on Amazon and other services that we use that we cannot get. And so we have to put on our gloves and our masks and go to war and go into the grocery store, which, by the way, my wife hasn't been to a grocery store in almost 3 years. So think about that for a second. I don't think that's just an isolated situation in the Modi household. I think this is happening all across the country. So I think it is a key issue that Amazon has to think about. And then we get to the whole number of hands that touch the box, right? That's another consideration that I think is going to become a big area of dialogue as we move forward.
Yeah, we're big fans of, and I know this sounds really strange in this case, but really kind of on-demand and localized manufacturing. So if you think of a farm as a local manufacturer and had been for hundreds of years, you're driving to a point where the elasticity of supply chain is not there, right? It cannot move up and down quickly based on spikes of pandemics of this kind. It's expecting a longer cycle before so that it can react appropriately. And I think with these sharp spikes, as you can see with the COVID virus spread, is our manufacturing and existing supply chains are built for very long-term, long projections out into the future. And I think we're going to have to accelerate and will our manufacturing processes to be more localized. We're seeing this in apparel. Even one of our companies is now producing face masks on these knitting machines all over the world, kind of like an Amazon Web Services for knitting, where they're essentially being able to take over knitting machines that are idle or not fully utilized, like a Amazon server, and spin up production of masks all over the country or world for that matter. So we need more elasticity. We've got various supply chains that have been built very traditionally. And that's also the case in consumer brands. It takes time to produce a product, but we've got to find ways to kind of accelerate both the innovation and the resupply.
Thanks, guys. We have a question here about, Nick, you touched on this a little, but let's double click. How do you see shoppers and consumers shifting to known legacy brands versus emerging brands as a result of COVID for now and post-COVID?
Yeah, and that's, this is literally the number one thing we are focused on right now, just given the nature of my coverage, right, which are large CPG companies. It was the disruptors were disrupting, they were taking share from the big brands. Then, because of share erosion, the big brands started to invest more. So again, COVID was accelerating something that was already happening. The soup category was already starting to come back, partially because Campbell's has started to reinvest back in the category and remind consumers how easy it is to cook a meal with Campbell's soup, okay? So that was already starting to happen. So yes, new consumers are coming to these big brands. Why? Well, number one, availability, right? It does pay to be big sometimes when you have these big supply chains and a lot of manufacturing capacity to make products when you have a surge in demand. Number two, consumers don't want to risk their capital. If you're going to pantry load 10 boxes of whatever, you want to make sure it's stuff that you trust and know. And so I think the inherent brand value of many of these large brands is really coming to the fore right now. Now we're going to start tracking the repeat rates and how many of these new consumers actually stick in the category. So that's something that we're going to focus on. But my suspicion is consumers are kind of reevaluating how they want to live, right? In a much more simplistic, things I trust kind of standpoint. And by the way, let's not forget that retailers are also figuring out, my God, people keep on coming in and buying these same quote unquote A-level SKUs, right? So maybe now the retailer is going to say to themselves, do I really need all this variety? I mean, this is playing out wonderfully in the beer category. Bud Light, Coors Light, Corona, all these brands that are well known are going fast. And then you have all these smaller craft brands that people wanted to experiment with is no longer happening. And I think this is being replicated across a lot of different categories right now.
But Nick, is part of that as a result of manufacturing limitations and supply chain limitations of these smaller brands? Because I would, that would be one. And the other one is, you're making a very good point, which is the larger brands are getting their act together and producing fewer, chemicals in their products. You know what I'm saying? The ingredients are better.
Yeah.
The storytelling is better. But, and so that obviously the gap shrinks, which is great for the big brands. And for the little brands, I think the struggle is they don't have the manufacturing capacity. If the button gets kind of pushed, they don't have the ability to scale up quickly, do they?
Yeah, I think it's a great point. So there's a lot of facets to this answer. Number one, that's why we looked at that frozen pizza example in the deck, right? Looking at some of these smaller brands versus the larger brands, and what we find is that the repeat rates for the larger brands is just higher, right? Because once you try a product, right, it's your intention to go and repeat. That's really the true, telltale sign if this product is going to really get repeat acceptance and the consumers are going to start migrating to that brand. So that's kind of point number one. The second point is, hey, if you're a retailer and you're carrying some startup brand and they couldn't supply, you're rethinking all of your calculus right now. So I think a lot of what's going to happen and how COVID-19, the permanency of what is going to happen is really going to come down to how retailers behave once we get out of this crisis. Do they have more space for A-level SKUs? Do they accept less new products that don't really have a defining, some big differentiating factor? I think a lot of the answers on the permanency of COVID-19 is really going to come out of retail and how the retailer and the category buyer is changing their philosophy, if at all.
I'm going to go into a rapid fire session because we have a handful of great questions here. Where do you guys see rental and other new business models going with potential psychological barriers in place now to reuse or rewear garments worn by others? Will this model be seriously hurt?
It's going to be.
I'll let you take that one.
Yeah, rental across the board is going to have to pass the COVID test. I think people are going to be very concerned for some period of time about touching anything that someone else has touched, if in fact it's not certified as clean. And that's going to put an extra cost to the entire recycle industry. And I feel like sustainability is going to take a major hit for the next 6 to 9 months. I mean, people are far more concerned about their short-term lives than they are about long-term, Earth. I hate to say it that way, but it's, to be very practical about this. Now, once that subsides and the fear kind of backs off, I think there's going to be a massive undercurrent. And I think it's sad to say, but I think we're going to have a massive dislocation on the economic front of the lower middle class and lower classes not getting anywhere back to where they were. And that loss of wallet is going to force them into more of a rental desire, need, if you will, than a purchase capability.
Thank you. Nick, former disruptors in certain categories, what CPG company is doing a good job of managing both mega and micro brands? How are they doing this well?
Oh, that's a good question. Boy, I cover 27 companies, so it's like scanning everything is tough to do in a quick moment like this. But, look, P&G, let me just give P&G as an example, right? I think that, over the last several years, they have really retooled how they do R&D, how they think about new product innovation. They've come up with some really interesting technologies on this dissolvable kind of, swatches that have some of their highest cleaning, highest efficacy cleaning brands, right? Whether it be detergents or dish detergent or shampoo, right? That's something that they've been working on for 15 years that cannot be replicated by anyone outside the company. They have patents over it. That's going to, it's 90% cheaper to ship online, no less water usage. Like, there's just a lot of great things. And then on top of that, they've been able to gain share in some of their biggest brands, right? Whether it be Tide detergent or, in their, prior to COVID-19 hitting China in their skincare business, big brands like Olay and SK-II. So I think they've been able, they launched Microban, which is a, basically a completely new segment for them in the kind of cleaning and disinfecting. That's a business they were never in before. So I have to tip my hat to them, the largest CPG company I follow, and they've done a pretty good job. But it took 10 years for them to get to this point. You know, Procter was didn't really have its shop in order for a good decade. And so it takes time. These things do not happen overnight. You got to build the capabilities. You got to be disciplined about it. And you got to invest a lot of money.
Thank you, Nick and Pano. Really appreciate the session today. And I'd like to welcome everyone who still has questions or wants to learn more about XRC. We'd love to set up individual calls, especially as it relates to the new corporate investment models that we're developing. So you have my email here, and we look forward to continuing the dialogue offline. Thanks to everyone, and stay safe. Have a great day.